evade the tax further. Or government has now figures of the advanced pricing arrangement, as well as mutual agreement. Now recently we have seen the statistics of around 200 cases which have been resolved under the mutual agreement procedure by the government of India. Most of the cases of the first year are related to capital contribution, but subsequently software and other companies' transactions are subjected to the mutual agreement, and therefore the government of India is bound to, should at least, if they call it as best practice, to tell people how many cases they have seen that self-adjustments have been carried out by the people, and they want to impose this law for those people. That could have been possibly one of the important thing which is lacking in this particular best practice. The threshold of 1 crore rupees exemption will go. The government says if your total adjustment is less than 1 crore, we will not make any secondary adjustment. Wow, what a graceful statement or law. UK. These are all best practices which have come from the OECD G20 report, BEPS Action 4. And from that, the countries have adopted all these practices. UK says in the draft circulated, we will not make adjustment if the total primary adjustment is up to £1 million, which is equivalent to today's value 8.3 crores. The Australia says we will not make a secondary adjustment if the total addition is up to 2 million Australian dollar, which is equivalent to 10 crore rupees. And we say 1 crore. How can we, if you are to align with the world, you must, and otherwise corresponding adjustment will be an issue by itself. If you do secondary adjustment, the other country also can do the secondary adjustment, and there will be major problems which are going to come little later. Our law does not recognize even the deduction of a primary adjustment made in the tax assessment at the time of assessment because of subsection 3 of section 92. No deduction can be claimed on account of any adjustment made on the transfer pricing regulation in the tax assessment. Now I can understand, you can say this law, that is the law for that year, but if subsequent year, if I have to pay something to my subsidiary or if I have to recover something from my parent, then that amount received also should not be taxed. Why should you tax that amount? Level play field should be there at both the places. And if I have to pay something to my subsidiary on account of some secondary adjustment made in the hands of that foreign enterprise which is my subsidiary by their tax department, will I be allowed to repay that amount? Will I be allowed to pay that amount in that country? Will foreign exchange management law permit me to make an adjustment? Will income tax department allow me the deduction of that secondary adjustment reimbursed by me to the subsidiary company? It should be both way around. It can't be one-way traffic. And therefore this is one badly drafted law, and you are talking about we are following best practice based on OECD G20, and that is what the misnomer is. Take the case of example. I have given this example in my explanation. If suppose you purchase the goods worth rupees 10 crore and if arm's length price is found to be at 7.5 crore, 2.5 crore rupees will be your primary adjustment, and on that secondary adjustment will be at 12.50, 12 lakh 50,000. I have calculated for the sake of understanding, the interest will be charged on the advance as per the tribunal's decisions, LIBOR plus 2%. But the tax office does not accept that LIBOR plus 2%. Tax office says, what is Indian prime lending rate? 10% plus 2%, so 12% I charge. That itself will lead to a litigation. The moment it leads to a litigation, transfer pricing. This secondary adjustment, whether, of course, the litigation will be only on secondary adjustment, not on primary adjustment, and therefore that is going to create more litigation. Let me tell you, friends, we are heading for major litigation on account of this provision, because the moment you accept secondary adjustment is slapped, therefore you are bound to give an advice to the client, and if you do not give the correct advice to the client, penalty of course you can be levied, because that is the wrong advice. So you will have to litigate on the subject of the adjustment and file an appeal to the higher authorities. Second example is on a guarantee commission, which also I have dealt with. Now the question is possibly the rate of interest. Our anxiety is to see what is the rate of interest at which the interest will be charged, which will allow to be charged in my books of account for secondary adjustment. In absence of rules, we can say so, but the rules will be notified by that time. Interest, etc., rate, foreign exchange, exchange rate, all those things will come up. And this is the experience from other countries, and therefore I have no doubt that will be clarified. Let's see what OECD says on that. OECD TP guidelines considers and recognizes secondary adjustment. But what they say, secondary adjustments can be made in 3 different ways. Our memorandum explaining the provisions of the law amendment budget bill also recognizes there are 3 different practices. First practice is consider the secondary adjustment amount as equivalent to constructive dividend. Because the foreign associated enterprise has retained that money, or I have paid excess money because of the ALP determined having been different, I have assumed to have paid this as a dividend. And therefore, whatever withholding tax is required to be applied, you apply and collect the tax. That's all. It's a constructive dividend or make changes in the law. Second way of doing secondary adjustment is consider this to be your equity contribution to the other company. Equivalent to the equity contribution, suitably make an adjustment in your books of accounts. This is the amendment, keeping in mind long-term objective. Because ultimately, if it is equity, when you sell, you will realize larger profit. And third is the constructive loan, this advance, what we have gone about. India has opted for the third category. We will treat this to be constructive loan. Let me share with you some thoughts on this. South Africa, when they regulated 4 years before, they introduced the secondary adjustment in their country, and they said it is constructive loan or advance, exactly like what we have done. We have copied from South Africa. But last year, after 3 years experience on constructive loan and great difficulties which I have narrated, which I am going to take you through, the South Africa changed the law. They says constructive loan doesn't work, and therefore we should treat it as a deemed dividend. We want to learn from somebody who has already got an experience, or we want to do our own, but our belief is we always want to do something on our own basis through trial and error. We don't want to learn from the other's experience. And therefore this is what the case is. A wise man generally learns from the other's experience. A fool only can do a trial and error and ultimately say that I am not successful. And that has a long-term cost. The difficulty South Africa found out was when secondary adjustment was made on account of this deemed loan or deemed advance. Now you calculate interest which is recoverable from that subsidiary or associated enterprise. How do you calculate interest? How many years you will calculate interest? How do you keep track of this calculation? Every year you go on, then the subsidiary does not pay. Let's assume associated enterprise does not pay. How many years you will carry on? And eventually you will find a proposal to allow write it off. And they take necessary approvals. Under the Indian regulations also you can take approvals and write it off and claim as a deduction bad debts. So therefore, is it that intended to ultimately? So this is going to be a major stumbling block. And those who want to study the South Africa's transfer pricing regulations, I think I have given a link. You can refer, and very detailed, elaborate paper on the subject of secondary adjustment exists on the website. Now, next question is treaty provisions. Does tax treaties provide secondary adjustment? That's the first and most important question. When it comes to international tax, you need to not only understand the domestic law, but also need to understand the treaty law. If you look at the OECD model, they have said it very clearly. It is not the purpose of paragraph 9. In fact, associated enterprise article is article 9 of both OECD as well as UN model, which is worded identically. In the commentary, OECD says it is not the purpose of this paragraph to deal with what is known as secondary adjustment. So therefore, OECD says secondary adjustment is not part of the treaty obligation, not at all. It has to be dealt with under domestic law. This secondary adjustment, which would require to establish the situation exactly as it would have been if the transaction had been at arm's length, depend on the facts of individual case. And it should be noted that nothing in the paragraph 2, subparagraph 2 of the main article 9 prevent such secondary adjustment from being made where they are permitted under the domestic laws of the contracting state. So OECD says we don't want to say that the treaty will get overridden, but you are entitled to make secondary adjustment based on the law in your country. So therefore, law can permit you to make secondary adjustment. Look at further. OECD says it resulted into economic double taxation. It recognizes the fact the rewriting of the transaction between associated enterprise in a situation which envisages paragraph 1 may give rise to economic double taxation. In so far as an enterprise of the state whose profits are revised upward will be liable to tax on the amount of profit which are already been taxed in the hands of the associated enterprise in the foreign country. If there is a transaction between two countries, you are making a secondary adjustment, but the profit made by the associated enterprise is already been taxed in its own country. So it amounts to double taxation. You say you can go for corresponding adjustment. Corresponding adjustment means what? Whatever addition you have made it here to relieve double taxation or economic double taxation, you request the competent authority of the other country to reduce their profit so that they pay less tax over there. Why should the competent authority of the other country agree to do that? And which is that competent authority will do that? Second thing, you can request the competent authority of the other country to do this only through mutual agreement procedure. This adjustment you have suffered in your own country, can you make a mutual agreement procedure to your own country? Is a question by itself. I was asking one of the joint secretaries who was resolving mutual agreement procedure. He says a challenging task, a difficult task. If you have to make a mutual agreement procedure, your tax treaties say you have to make an application to the competent authority of the other country, who in turn will make the application. He will forward the application to the competent authority of your country, the other country, and then you resolve the dispute. And that is going to be a challenging task. We will see how it will evolve and eventually develop. Paragraph 2 of Article 9 provides that the circumstances the state B makes an appropriate adjustment so as to relieve double taxation, then it is possible that no economic double taxation takes place. But the other country's competent authority, why should they forgo your revenue? Look at our experience India had with America. When the competent authority initially resolved some MMP disputes with USA, accepting a particular percentage of profit earned by software companies, American companies gave economic double taxation. To relieve economic double taxation, they gave corresponding adjustment. But later on, when they realized that they are making a mistake by giving corresponding adjustment, because those companies ought to make some profit and they pay tax in their own country, in the USA, they stopped giving corresponding adjustment. Indian authorities took a view, why should we resolve the matter under the MMP? And that created a major dispute between India and USA. Eventually the matter was taken up at the highest level, and you all know the circumstances which I will not deal with here. Eventually the government of India came under the pressure, and we have resolved all the mutual agreement procedures US had pending with us substantially, not all. Pending, and therefore now today the relationship has been improved, so we have resolved all the dispute. So therefore, if this is the way you are making a MFP as a tool to negotiate and resolve a lot of other issues, I can understand. Trump coming up and becoming president and making all of a sudden a statement, China one policy will not work. It means you make a statement against China and then finally said next day, of course, we can recognize China's one-state policy, provided there is some give and take between us. You give up something in our favor, we will recognize this as one state policy. So if that is your agenda, possibly you can understand, not otherwise. Look at European Union's secondary adjustment report, a final report which was issued in 2012. They said also it leads to difficulties, it leads to double taxation, it leads to economic double taxation, absolutely. And therefore, care should be taken to introduce such regulations. If you look at the Europe, out of 34 countries, 10 to 12 countries only have secondary adjustment provisions, not all the European countries. But of course, now with OECD and G20 coming up together, and they are coming out with this regulation as BEPS Action 4, possibly the world is changing towards a different way of life, and you may find there the secondary adjustment also coming up in those countries. The issue which I was trying to possibly take up is whether these provisions are retrospective. Look at the provisions which they read. Proviso to section 92CA, CE1, which reads, provided that nothing contained in this section shall apply if the amount of primary adjustment made in the previous year does not exceed 1 crore rupees, and the word is used as and so therefore both the conditions must be cumulatively fulfilled, and the primary adjustment is made in respect of an assessment year commencing on or before first day of April 2016. And therefore, if you follow these two conditions cumulatively, the secondary adjustment is possible only up to assessment year 16, 17, and therefore is it intended to cover up the cases or bring about the adjustment only in those 3 years which are pending, 13, 14, 14, 15 and 15, 16 assessment on transfer pricing going on? Is it intended to cover up those 3 cases in issue by itself? Practical difficulties. Number of issues, number of practical difficulties are likely to arise because of the secondary adjustment, which I would like to take up few of them, very important amendments, very important difficulties. The laws of a jurisdiction may not allow repatriation. For example, let us take the case, you have a subsidiary in Nigeria, or says these African countries, North African countries which are difficult exchange control situation, they cannot remit the money. And your officer here makes a secondary adjustment. Undervaluation, overvaluation, blah blah blah. You won't purchase anything from them, but you will sell the goods to them. So therefore there is an allegation that under invoicing has been done. So therefore primary adjustment has been carried out on your transaction. Now therefore once the primary adjustment is carried out, the tax office, the assessing officer says, the taxpayer says, anyway the amount is 2-3 crores, let's accept, not file an appeal. Secondary adjustment. Those countries cannot repatriate even the original amount. Where is the question of secondary adjustment interest thereon? And that is going to lead to second secondary adjustment in subsequent year. So these are the difficulties. Exchange control regulation of those countries, these are the difficulties. They may not allow the repatriation. So therefore, if the situation of this nature is not provided in the rules or not provided in the law, it is going to create major difficulties of doing trade internationally. It becomes a protectionism. It becomes a barrier on international trade in our country as well. If the entity with which the transaction took place ceases to be an associated enterprise. Today it is an associated enterprise. Suppose one of the conditions in associated enterprise definition, if you look at, very interestingly, there are A to M 14 conditions which have been given, which lists out associated enterprise examples. One of the examples is you have done business on the basis of franchising. Your sole business is dependent upon the franchising of the foreign enterprise. And an adjustment is you have been paying interest or you have been paying royalty to them. And you are told that the royalty paid by you is excessive, 10 crores should not be paid, only 3 crores should be paid. So 7 crore adjustment is carried out. The foreigners say, hell with you, I don't care. If you have paid, if the adjustment is made, you bother about it. Why should I reimburse you? I am not your relative. I am a third party. I am selling, you are doing business on the basis, I am obliging you by giving a franchising. What the hell you are talking that 7 crore I should pay? Nothing doing secondary adjustment if you accept that. Otherwise you have to dispute. You have to litigate against that. Or if the AE ceases to be in existence, Suppose the franchising company has gone insolvent. The franchising company is not available. No more. Though you have been beneficiary of doing franchising business here. How do you recover? From whom you recover this money? Second example, classical example is you are purchasing goods, 90% of goods from a Chinese company for resale here. You are considered to be associated enterprise. Next year that company is no more available. Wherefrom you are recovering? 3 years later the transfer pricing adjustments are made. Now 2 years, now the time period will be reduced. How do you recover this money? Wherefrom you recover the money? And next year you have not made any purchases from that company, you have got an alternative source. You said last year it was associated enterprise. This year, sir, this is not I have not done any transaction with that company. It ceases to be my associated enterprise. We don't care. You recover that money. How do I recover? Now, in this context, third criteria. If you made a sale to a company and the price is determined by the seller, it means, or he is negotiating, the buyer has negotiated the price and determined by him. Both have become associated enterprise. And the third criteria, what is the percentage of sales are required for the making that associate, for the other company to be regarded as an associated enterprise? The law is silent. The law does not explain how much percentage of sales should be made to the other party. As far as purchase is concerned, 90% they have said. As far as sale is concerned, 0. Nothing is specified. So, possibly even 5% sales could be regarded as your associated enterprise. The relationship of associated enterprise comes into existence. And if associated enterprise relationship comes into existence, you need to comply with the transfer pricing regulation. In this context, very recently a tribunal in Chennai has decided, taken this cause very uprightly and very correctly, and that I am going to deal with possibly as a next item after some few seconds, and that is very interesting item of our discussion today. So therefore, these are the difficulties which are going to be arising on account of the secondary adjustment. Now, repatriation conditions, if it is not possible, impact of secondary adjustment will be perpetual as long as the company is in existence. So should secondary adjustment be, therefore the issuer is, should we learn from the experience of South Africa? Should we say that secondary adjustment should be only by way of a deemed dividend and not by way of a loan? We will do it only after learning our own experience after some years. And therefore, this is one major area of concern. Possibly, when 3 options are available, what is the best option available for the country in the interest of garnering revenue, generating more and more revenue? That should be followed rather than only litigation. Unless our Institute of Chartered Accountants has implanted some people in the CBDT to give more and more work to the chartered accountants. So we create such regulations which will create litigation. Then it is acceptable, not otherwise. So will secondary adjustment is also made in the hands of the foreign enterprise. Now, an interesting case. Here is a case recently decided by, just 2 months before, a company in Calcutta, Instrumentarium Corporation Limited, a